Now, Property Monday continues as Margaret Lomas and her team answer all on Your Money, Your Call.
Welcome to the Monday night edition of Your Money, Your Call. And you know, if it's Monday, then we're talking all things property. I'm Lisa Montgomery filling in for Margaret Lomas, who will be back in the chair next week. And tonight we have another jam-packed 1.5 hours of property news and discussion for you. And of course, as usual, we'll be taking your calls and answering your emails to help you make better decisions regarding your personal property investing journey. Now, to kick off tonight's program, I'm joined by our regular guests, Damian Collins from Momentum Wealth and Bradley Beer from BMT Tax Depreciation. And tonight we will be discussing a number of hot topics, including interest rate predictions, listing in winter and buying off the plan. As always, we invite you at home to be part of the discussion. Indeed, a very important part. You may want to comment about one of the issues of the day or have a question for one of us on the panel. And if that's the case, then pick up the phone and call us right now on 1300 30 34 35, or you can email me right now on property@skynews.com.au. Welcome to the program, and welcome to the program, gentlemen.
Thanks, Lisa.
Yes, yeah. It's good to see you. Brad, you were hosting last week, so you're kind of like in the other seat.
Move to the next chair.
I know. What is this like? So we just keep moving around the circle of this table.
Next week over there.
That sounds like a good idea, good plan. So Margaret's away, but she will be back next week. But I think we've been holding the fort quite well. And I wanted to start the show off tonight with talking about the new tax year, because I know that many investors, when they approach the end of the tax year, are really scrambling to get things done that they need to get done. But are there some sort of simple tips to set you up, to put you on the right foot? Damian, what do you think everyone should be doing as they enter this next tax year?
Well, Lisa, it's really about thinking ahead to where you're going to be in 12 months' time, and in terms of are you going to be buying another property, thinking and planning ahead for that. But from a tax point of view, look, there's not a huge amount you really need to be looking at. A lot of those decisions, you know, you might think I might prepay some expenses, but that might make more sense towards the end of the tax year when your financial circumstances are more clear. So, so not a lot to do. I'm sure Brad will talk about depreciation reports and the benefits of that, but other than that, I wouldn't be doing too much at this time of year.
Well, I'm sure he will. And in addition to depreciation reports, you know, is it a time, Brad, for people to be reviewing their insurances on their property, reviewing other aspects of their relationship, perhaps, with their agent that's looking after the property?
Look, I think if I look at the sentiment of the people that do buy schedules, there is more of them that do it prior to the financial year. It slows a little bit in July, and then really it picks up to those that are actually doing that tax return, starting to go off to their accountants, and their accountants saying you need these schedules. But I think planning your tax year, or with your buying property, whether you've got property, there's a lot of things about your tax that you need to know, and you need to start planning and thinking about now for this tax year. What is my tax year going to look like? You probably know roughly what your income's going to be, and really from not just a tax perspective, but an overall wealth perspective, you're experts in making sure everything's put in place from now, rather than scrambling at the end of the financial year and coming to the end of that. Reviewing your agreements with your property managers and things like that. I tend to, on a yearly basis, I have a lot of different property managers in different places, and you know, always get the once a year, is my rent up to date where it should be? Everything about your property needs review, not just your tax. And the smoke alarm's being looked after properly. Having your own actual look at all those things across the boards, I think, a good thing to do throughout the year. But you know, if tax time's the trigger, let it be the trigger.
Yeah, I think, well, it's a good anniversary, isn't it, that we can look at, that is a point in time, a milestone that we can look at as a time to do that. Yeah.
I think things like insurance are done whenever it actually comes due. And making sure it's right is important. Construction costs being right is important, and making sure that you're correctly insured is important. But again, not necessarily a tax time thing. Something you should be thinking about all the time, or when it's required.
Absolutely.
Depreciation schedule is obviously important. We do have a number of those that do happen this time of the year. I guess people are better these days, I think, from my perspective in my 17 years at BMT. More of them, and we've probably helped that, to say you should think about these things before the end of the financial year. But I think the fact that there's still this rush that happens afterwards, now it's much better than it was, but the fact that people are uneducated a little about depreciation, about certain things about their investment property in general, is something that could be better done across the board. If you're rushing to do it after tax time, it's probably something that, if it relates to this tax return, you should have maybe been thinking about from now for next year.
Yeah, yeah. It's funny, we're a bit of a set and forget society when it comes to our finances, you know, and I blame technology for that, because, you know, you can, you know, set things up to come out of your account automatically, out of your transaction account, you wait, everything's done electronically now. So we don't have that ability to touch it and see it as it's coming through. It's just automatically happens, doesn't it, Damian?
Absolutely.
Yeah.
So, and one of the things I noticed with investors too is we talked about regular reviews. Your loan reviews are really, really important.
Oh, absolutely.
So many times we see people come into the office and they've had a mortgage somewhere else for a period of time, and they get to it's rolled over from a fixed rate, and the banks generally roll them onto this full variable rate, not this discounted variable rate. I'm amazed at how many people are paying, you know, anywhere upwards of 1% over what they could be getting.
Yeah, actually, I want to come back and talk to that, but we've got a caller on the line, and our first caller tonight's Joe. Joe, you're from Sydney, and you want to talk about a property, or putting a deposit down on a property in Fortitude Valley, is that right?
Yeah, I've put a deposit down already.
Okay.
It's a 2-bedroom, 2-bath, 2-car spot unit in Fortitude Valley.
Yes.
I just wanted to get the panel's thoughts on, is it a good investment? It won't be ready till mid-next year.
Mid-next year?
Yeah. So,
okay.
It's off the plan.
Right.
And am I doing a good thing?
Well, I'll just ask you a couple of questions.
Sure.
How many units are in the complex?
24.
24 units, okay. All right. So 2-bedroom, 2-bathroom, 2-car spaces. Let's go to the panel and find out what they think about it. Joe, Damian, you first. Fortitude Valley.
Yes, I know that area, Joe, well. Look, we certainly think Brisbane is going to do fairly well over the next 3 years as a whole. That's our market that we think will do most likely the best in Australia out of all the major capital cities. But unfortunately, apartments, particularly in that new city area, are going to be going into quite a significant amount of oversupply. So I don't think they're going to perform particularly well at all. And I guess that's the risk you take when you buy off the plan. If you, it was 24 units, you said mid-next year, so you might have purchased it, I'm guessing a year ago perhaps, I don't know, but look, I wouldn't be expecting a lot of capital growth upside on that one, Joe. I just think there's that market, and the rental is going to be pretty tough too, just with the amount of supply. So you might be in for a bit of a tough road. At least you're in a boutique complex. I think you're better off in that rather than being in one of the, you know, much larger around the city, 100-plus complexes, but that'll be a benefit for you relative to others, but there is a bit of apartment oversupply.
I think that's right. You know, the 24 units in this complex is probably the best thing about it. But I guess what we've got to also be looking at, not just the value of the property once it settles and he's bought it, the yield. You know, you alluded to it there. I mean, the yield, are we going to end up with a lot of low-yielding properties when this glut of apartments come onto the market?
Look, and they said, I think, Joe, one thing, you've already done it, so it's a late question, I suppose. But I think from a yield perspective, one of the risks you've got here is you're settling. Now, you're in a boutique complex, which I agree is probably a good thing about that. It depends what you actually paid for it, and did you pay something that means you might have some damage about that. But from yield, when it gets to that point when it's about to be rented, there could be investors throughout that block, or there could be quite a few, and there's probably quite a lot of other stock coming onto the market at the time. An important thing, I think, with all rental properties, and that I look at when something becomes vacant, is you need to fill it quickly. And then you're in a market where there's possibly a lot of stock coming on the market for rent at that time. Every week it's vacant, if you're trying for that extra $20 or $30 a week, is the week of the full rent, or whatever that actually is, that you lose. So if 20 are coming on at the market at the same time to rent, you've got to be the best of the 20. And for your numbers from a yield perspective, full is better than vacant looking for $30 a week extra or whatever that actual number is. So not getting, if you do have a lot there, thinking to yourself, well, filling it up actually is better for me. And I see, I talk to a lot of people that have got properties, or a lot of the real estate industry and property managers that have the frustration. My property managers are scared to ring me about a rent reduction because they think I'm going to be unhappy with that. But the mentality of the investors should be full is better, and should be, I've got to actually play with the market today, not what someone told me when I bought it a year ago I should actually get in rental, because that becomes an irrelevant number. At the end, you've got to get to settlement, obviously. You've got, you know, sometimes off the plan's got some things with it where you need to make sure it's delivered, and it's, if you're not from the area, make sure you get it properly looked at by someone from a defect perspective. Some things to consider, but it's a good, it could be a good little learning curve for you.
Well, it might be too. And just before we finish up on Joe's question, just thinking also, Damian, about when this actually does settle, there'll be a bank valuation that will need to be done. And I don't know how much deposit Joe's put down, but he needs to be working with his mortgage broker, doesn't he?
Definitely.
To make sure that he's okay.
Definitely. Look, Joe, I'll be talking to my broker at least 4 to 5 months out from when this is going to settle. And this is where a lot of people get stuck. They put down their 10% deposits for off-the-plan properties, and they don't even think about it. They just think, oh, well, that's what I paid for it. Surely that's what it's worth. And when you move into markets of oversupply, valuers get very nervous because they're on the hook to the banks for any incorrect valuations. And you do find that it could come out under. So you'd want to make sure you had some spare cash potentially, just in case it comes in undervalued from what you paid for, because you might have to come up with more deposit.
Absolutely. So that's just one really, just to keep taking the temperature on, Joe. That's one piece of advice I think that we can give to you. And it's hard when it's retrospective and you've already made that deposit. Well, thanks for tuning in. And even though she's not here tonight, we will still be giving away 2 of Margaret's books to the questions of the week. The panel and I will choose 1 question from the emails and 1 from the calls, and those people will receive Margaret's book, How to Achieve Property Success. And if you're ready to invest, this book will make sure you tick all the boxes in relation to the process. Now, in addition to this, I have a very special giveaway book package tonight. I've got Bite-Size Advice and Bite-Size Advice 2, and these are by the author and veteran financial services executive Paul Thomas. Now, these books are a collection of his weekly blogs, and that is that they, in short, they explain how the world works in relation to politics, business, society and technology. Now, they're a great read. I love them because you can kind of pick them up and put them down. You don't have to read the whole thing. All the information's presented in bite-sized chunks, so you can use it as an anytime reference tool. Now, these books will be given away to our next caller. So please, if you want to call us now on 1300 30 34 35 or email property@skynews.com.au with a question. Then make sure you watch at the end of the show to see if you're one of the lucky winners of Margaret's books, but the next caller will definitely be getting this book package. Welcome back, and thanks for joining me for Your Money, Your Call Property. I'm Lisa Montgomery, filling in for Margaret, and joining me tonight is Damian Collins from Momentum Wealth and Brad Beer from BMT Tax Depriciation. So don't waste any time, not a second. Call us now on 1300 30 34 35, or of course you can email us on property@skynews.com.au. Now we have our second caller, and that's Nick. And before Nick starts, Nick gets the book package, so he's very excited about that, I expect. Nick, how can we help you tonight?
Hi, Margaret. Hi, panel, and thank you very much for that. I'm looking forward to reading those books.
Excellent.
Yeah, look, I'm just looking for some guidance. I have an investment property which is unencumbered, and I have a second one, which I still have a loan on, and an opportunity looks like it might be coming up for a third. So what I'm looking for is to extract the equity out of the second property, which I have a loan on, which could fix up my deposit, and then obviously the balance will be on the third one with the bank. And so if I do it that way, like the 50,000, would that be like a separate loan to the one that's on there already? Because basically what I'm thinking is I could sort of pay that 50 off, or would the bank put that on top of what I owe to make it like a cumulative sort of loan then in terms of collateralisation?
So Nick, is the outstanding debt that's on that investment property, that number 2, that loan, is that for investment purposes?
Yes, it is.
So it was for that property. Then you've got your first property, which is unencumbered, and then you're looking to buy a third. Okay.
Correct. But what I want to do is get the deposit
out
from the second one, and I'm just looking how they would treat that. Is it like a separate one, or would they put it onto? Like I owe 150 on the second one.
Right. How much equity do you think? What's that property worth? Do you know the second property?
It's probably around just early 300s, maybe 310.
Right. Okay, I could answer that question, but I'm going to go to Damian Collins, and he's going to give you his answer first. Damian, what would you advise Nick to do?
Nick, firstly, well done on having one unencumbered investment property. That's great, and you've only got, I think, 150,000 debt on your second one, so about a 50% loan-to-value ratio. So you're on the right path there. Look, the way we structure our loans is definitely we do not cross-collateralise. So what you can do, and I was going to ask about your loan-to-value ratio, but you are well under that 80% currently, and even if you took out another 50,000, that's only going to take you up to about 200 on a $310,000 loan. So the reason I ask that is because you don't want to pay mortgage insurance unnecessarily when you already have an unencumbered property there. So if you took it up to another 50,000, basically it can be pretty easy to have it treated separately. It can be separate splits on a loan, depending on how the lenders might do it, or you can have it as a separate loan on that particular property. So you can pay one up and down. You can pay one down over the other one. So that's a good thing to be aware of. The other thing I would mention, it's been great that you've paid off clearly off one investment property and you say you want to pay down the other one. Now, we haven't discussed your personal circumstances. I'm always a big fan for financially disciplined people of putting money in an offset account. So if you're a great saver, which it sounds like you are, I'd be looking at, and you're pretty comfortable that if you put it into a bank account, you won't spend it. I would be looking at offset accounts. And the reason for that is once you pay off investment debt and you want to get that money back again, let's say you want to buy your own private home or you want to take a holiday, the difficulty is that if you borrow again to use it for private purposes, you've created non-deductible debt. If you had it sitting in an offset account against the deductible debt, then if you draw money from a cash bank account, even if it's an offset account, you're not impacting the deductibility of your loan. So I'd certainly be recommending looking at offset accounts rather than paying down loans. And yeah, certainly definitely don't cross-collateralise. Get the increase on your second property and use, even if it's the same lender, it may well be if they've got the best product, but don't have the cross-security for both properties. Have them stand alone.
So Brad, you know, when we're talking about cross-collateralisation here, sometimes it's difficult to unwind that arrangement. If you've got a poorly performing property and you've got 3 tied up in one loan arrangement, so it's difficult to extract that from that unperforming property from that arrangement. I was just doing some sums here. It looks like Nick's got about $90,000 worth of equity in if that property's worth 300. We really want to keep him out of mortgage insurance. What would your advice be?
Well, I guess what I do personally, as opposed to advice.
Cross-collateralises.
No, I'm a firm believer. I agree with not cross-collateralising, because what it does, like anything, is really take away your flexibility. It takes away your ability to make your own decisions. The bank gets to make decisions with things that are crossed against each other. I actually, in my whole portfolio, I did it once because at the time I didn't have the equity to do anything else, so I didn't actually have the option, which is not you. And it actually, I had one property out of the 2 that I crossed that actually performed pretty badly and one that performed pretty well, but it took away my flexibility to probably, as I do like to do, I do refinance and I do re-borrow that equity where possible, so that when this opportunity comes up, rather than having to go and ask the bank for that money to see if they'll loan it to me at that point, I borrowed it in the past from that property, borrowed that equity, sat back in offset accounts so that I'm not paying interest on it, and I've actually already freed up the cash when I didn't necessarily need it, and then you're really standalone looking for that other property. So I have made the mistake, but it wasn't a mistake. I knew at the time. I didn't actually have an option. I do really like, and I think for you, you've got a fair bit of equity in properties there. We didn't look at the value of the other property, but finding out about that, and I think the equity is a little lazy for you in your properties, and the concept of looking at a longer term, I guess, plan for your future with someone that really understands, you know, the benefit to you and your personal situation of things like offset accounts, of what is it going to look like in 1 year, 5 years and 10 years for you if you actually use that equity to advantage and keep that risk down to the point that you're actually comfortable with. That'll need someone who's qualified to give you some of that advice, as opposed to, and that really understands your financial situation and give you some financial advice on that. So I'd probably go and get some of that, I'd say.
Because the mortgage really is a tool for wealth creation. It's my thing. I always bang on about it. And you know, you really need to have somebody who can show you how to use that tool as a tool for wealth creation and to structure this this next loan correctly for you. It may be that there's a dual property security here with the one that's unencumbered and the one that you're purchasing to keep you out of the mortgage insurance threshold, which is 80%. And so that might be something that you'll end up doing, but you really do need to get that quality advice, Nick, so that you, some of it might be in the bite-sized advice that I'm going to send to you, but definitely through a qualified mortgage broker that's actually got some history in structuring property investments and portfolios. That's really what you're looking for. So far a great night, but we have so much more lined up. It's time for a quick break, but we'll be back soon. If you do have a question for us, call us and join the queue on 1300 30 34 35 or email property@skynews.com.au. You never know, you could win the question of the week. We'll be right back. Well, if you've just tuned in, there's still plenty of time for you to call and join in the discussion. Tonight, Damian Collins from Momentum Wealth and Brad Beer from BMT are here and ready to help you. So call us now on 1300 30 34 35 or you can email us on property@skynews.com.au. And our next caller is Pulsey. You're from Sydney and you're after the growth prospects for Brisbane, is that right?
Yeah, that's right.
Okay. Tell us what you're planning on doing.
I'm just a first property buyer and just looking for, I mean, what's the prospect for Brisbane? Everyone says that Sydney and Melbourne is unaffordable. Just looking what are the risk factors to consider at this time, and what would be the the rate of the yield, and what's the best place to buy if I have to buy at this time.
Okay. And have you done any research on what type of property that you might want to be buying, like a unit, or you might be looking at apartment or perhaps a house? Are you looking at anything in particular?
Unit.
A unit. So you're looking at a unit. Okay. All right. Look, I'll go to the panel and let's see what they come up with. Damian.
Pulsey, yes, I think certainly Brisbane overall is likely to outperform Sydney and Melbourne over the next 3 years, and so good on you for considering outside your home market. A lot of people always like to stick in their own home market when they're buying an investment property. Well, look, I guess the other issue you'll have is you haven't mentioned a price there, Pulsey, but certainly you mentioned units, and as we've already discussed on the show, I would certainly be keeping well away from that inner city high-rise large apartment developments, because they're going to have a substantial number come on in the next couple of years, so I'd be keeping well and truly away from that. Look, some of the areas that we like are Nunda and Chermside. Nunda's a good location on 8-9 kilometres from the city on a train line, and Chermside's one of the strategic areas for the Brisbane City Council over the next 30 years. So a lot of infrastructure and things happening in those locations. Obviously, another thing you need to be thinking about how you're going to buy remotely. Certainly you might want to think about using a buyer's agent up there, someone who can be on the ground looking for that great investment property for you and help you with all the inspections and other things you need to arrange, negotiating the contracts, etc. So certainly be thinking about that. But yeah, I'd keep looking in Brisbane for certain, but keeping away from those inner city high-rise apartments.
Yeah, that's a good piece of advice. What do you think, Brad?
Well, I probably concur on, if you look at all the reports that are coming out at the moment, there seems to be a fair bit of concern about inner city apartments, and it's not just Brisbane, it's probably across a lot of the capital cities. I think the concept of buyer's agents, as you say, or enough research yourself to find the pockets of areas that actually have the things that probably have a bit more potential to grow, where you don't have maybe a major amount of competition with inner city high-rise apartments that there's plenty of talk that maybe there's too many of those coming out of the ground at the moment, means you probably prospect for growth out of those things. It's probably got a bit of a longer term ability, and we're talking about how do we make sure the yields, if there's lots of them coming at once, actually stay there. Outside of probably CBD, I think good. The fact that you've decided on a unit at such an early stage, I think probably sometimes concerns me. Why are you limiting yourself to a unit? Is there a particular reason? I think whether it's a unit or a house or a townhouse probably has more of a dependency to me on the area you're buying and what the people in the area actually want to live in now, and what you believe is the case into the future. So maybe broaden the horizon to the thought of the area, the reasons that are going to drive growth in that area, and then what the people in that area want to actually live in. That's some of my thoughts.
And it's transport too. I mean, we've looked at some of these outer suburbs. I mean, Margaret talks a lot about the outer suburbs of Brisbane, particularly up toward Deception Bay, Redcliffe, those areas where the transport infrastructure is improving. It's really looking at those sorts of things. And it probably would pay Pulsey to get a copy of Margaret's 20 most asked questions before you actually go up and start to make some decisions, Pulsey. I would advise you to go onto the Destiny website and have a look for Margaret's book, because those 20 must ask questions are really going to help you. Okay, on to our next caller, and that's Paul. Paul from Melbourne. How can we help you this evening?
Good evening. Thank you very much for the call. The question revolves around my current situation with, I have 5 unencumbered properties, of which 2 are commercial and the other 3 are residential. They're currently modestly geared at around 65 to 70%. I've been trying to have a look with an accountant and a financial planner generally, and I'm getting some general advice, not specifically to my cause or my case just yet, but I'm heading in that right direction, trying to make a decision about a high gearing strategy with low interest with the current market interest rates that we've got, and then use the surplus, because there'll be a large surplus of an available credit line to go into potentially, and I was just hearing some talk about the Brisbane market potentially, and Margaret Lomas likes the Logan and Logan Shire area from my recollection.
Yes.
So potentially then investing the line of credit that I might have from the lender, and then hopefully be able to get into the next stage of my investment cycle. I'm in an age now where I'll be having some good superannuation benefits, subject to the Liberal government letting us have a few flexible options, hopefully, and not...
Well, we'll wait for that, Paul, I think.
Wait for those.
Yes.
So they are on the to-do list as well. So at this point in time, the real question, the core question is it a wise strategy for me in my 50s to do something like a broad refinance over those properties and then perhaps use the line of credit, which should be reasonable, Lisa? The line of credit...
well, let me just ask a few quick questions, a couple of quick answers. So you're saying to me that you've got 5 properties, 2 commercial, 3 residential.
Correct.
And they are unencumbered. You don't have a loan on them at all?
Currently unencumbered, but I do have some other minor business debts that I've sort of incurred that are not traumatic, but
okay.
And that could be something I could apply some of the monies towards in this low interest environment. Hopefully, we're looking towards the Reserve Bank possibly reducing rates again.
Well, that's what they say, potentially in August.
Potentially in August.
So the other question I've got for you is, where are these properties situated around Australia?
Yes, one property is, the two are here in Melbourne locations. One in Templestowe.
Templestowe, yep.
And another one in Greensborough.
Mm-hmm.
There's a little story with Greensborough. It was an amazing mortgagee auction.
Oh, well, it sounds like you got a good deal. And what about the others? Are they all in Victoria, I guess,
Yes,
is
all
my
in
question.
Victoria.
Okay.
Yes,
so,
they are, and there's some land tax issues there that I should be aware.
Yes, well, you are aware because you mentioned it. So I'm going to go to the panel now, Paul, and see what they will advise you to do.
Yep.
Okay, to you, Damian, first.
Paul, look, I'm always a fan of taking debt when the opportunity is there. Again, only if you are a person who can manage their debt, not spend the money. I'm always someone who thinks take the loan. You don't have to spend it. You don't have to use it, but at least it's there when it's available. Often people go and apply for debt when they need it, and so they might not be in the situation where they can actually find it. So again, you need to definitely be someone who's going to manage their money well. You don't want to go and get into debt. Look, lines of credit are pretty much, unless you're utilising them for daily transactions or far more frequently, pretty passé now in property investing. I used to use them years ago, but for your typical investment property, they've got redraw facilities. Unless you're paying up and down multiple times, many times in a month, it's a line of credit. For the price you pay on a lot higher interest rate doesn't seem a good value to me. So I have only one, which I use in my business. It's secured against a house. It funds in and out. But other than that, all mine are standard investment loans with redraw facilities. As for one of the couple of things you might need to be aware of is that certainly with residential properties, you can generally go and get a loan for a 30-year period of time, set and forget. You'll never get any questions from the bank. As long as you make the payments, you generally won't be asked for any reviews or have any changes on that particular investment property. Commercial world's a bit different. They tend to do more reviews on those properties, so it's not you can just get a line of credit or loan facility against a commercial property. They may well tie it to a lease review time, and then at that time you will be reviewed. Now, just be aware that, of course, if for some reason your circumstances have changed and you can't pay back that loan, the bank might ask you to contingency plans or make you sell that particular property. So not as simple on commercial properties as it is residential. And in terms of is it's a good strategy for you, well, obviously we can't answer that question without... You gave us a lot of detail there, Paul, but you need to go and seek your own independent advice. You mentioned you've spoken to an accountant and planner. Look, it is a low interest rate environment. Do we think property is going to run away in the next couple of years? Nationally, no. Brisbane might do the best, but I'd be certainly going and talking to my accountant, talking to your advisor and saying, well, here's my 5 or 10 year plan, and you need to be comfortable with that amount of debt and what you're proposing to do.
Look, I think you just hit the nail on the head. What's the plan? What's the end game here for Paul? And I think that you have to establish what that's going to be, Paul, and then work back from that in relation to whether you do gear these properties and borrow more money to buy another property. I mean, this new property will have to fit within the scheme of your strategy, and I'm not really just sure that just picking Brisbane out of the hat is because even though Margaret's very learned about these places, or picking Logan out, whether that's going to be the right strategy for you. Brad, what do you think?
I think the most important thing I pick up from that, Paul, is you talked about having some advice that wasn't specific to you. And I think you need some advice from someone who's qualified that is specific to you. Your risk, whether or not the concept of borrowing money against existing property to use to invest in more property, I don't have an issue with. I think providing it fits with you when you get your specific advice, your risk profile and things like that, it's definitely a strategy that will help you to get into more property. I don't think in your 50s you're necessarily too old to invest into more property at all, having not been there. But I think specific from someone qualified to help you with more that 5 and 10 year plan, as opposed to, well, I'll just get some money and maybe buy some property, I suppose is probably what I would suggest.
Yes, yeah, look, I think that there's some specific advice there would be absolutely critical to you making the right decisions. You've made some fantastic decisions to date. If you've got those 5 properties and in the main they're unencumbered, I think that's it's a great position to be in. But whether you need more, there's nothing wrong with that concept, but whether you actually need more to fit in with the plan, I guess that's the question. Now to some news, and confidence in Australia's property market is at its lowest point in more than 3 years as the aftermath of the federal election campaign and restrictive taxation arrangements weigh heavily on the sector. Released last week, the June edition of the ANZ Property Council survey has revealed consumer and industry sentiment around Australia and real estate is at its lowest point since December 2013. The survey takes into account current conditions as well as future predictions to determine the level of confidence around real estate, with a score of 100 on the index considered to be neutral. The confidence index came in at 128 from the June survey, and while that's still a positive reading, it's dipped 3 points since the previous survey. The uncertainty created by the longest election campaign in half a century, don't we know it, and recent state government decisions to increase property taxes are taking a toll, said Ken Morrison, Chief Executive of the Property Council of Australia. So, gentlemen, it's interesting. We were talking about a lot of the conflicting information that we're hearing out there in the marketplace about whether confidence is high, whether confidence is low. What's your take on it, Brad?
Look, I think the election is probably a very big driver of this situation. It's uncertainty. The election or elections, actually, we can see in the numbers of depreciation schedules audited in our numbers sometimes. It drives sentiment unnecessarily. People actually sit on their hands.
Yeah.
Whether it's something that's affected by the election or not is seemingly irrelevant. Now, property was in the election as a bit more of a discussion this time than it probably often is. So therefore, I think people are more likely to sit on their hands a little bit more with anything to do with property, which I think we have actually seen. I probably agree with the Property Council that things like the raising of taxes here and there, state governments that have probably treated property as the coffer of their ways to make more money, attacking foreign investors and charging them more to probably try to curb that, which is revenue raising for state governments, is probably really going to affect people's sentiment, really going to affect people's decision making in property, and they'll tend to sit on their hands, and that is really what that is saying. Yeah,
you know, it's interesting because it used to be that consumer sentiment and confidence was like, you know, you turn a slight knob on the cash rate down 25 basis points and everyone seems to be happy, Damian, and confidence is restored. But confidence now is a much more complex algorithm, isn't it? Like it's a whole bunch of things, and the 24/7 news cycle really propagates that to a certain degree, doesn't it?
Well, it does, Lisa. As you mentioned, when the rates go down, people go, oh, there's something wrong with the economy.
That's right. That's right.
What's going on? They're having to cut it. And look, I think it was a combination of factors. A lot of people. I was amazed at how many people thought negative gearing was going to be retrospective. I guess people sort of just get sound bites and not tune into election campaigns, what's happening. So a lot of people thought that Labor's changes were going to be retrospective, so that impacted confidence. And I think the other thing that is also mentioned, there's been some slaps on very high stamp duty rates put on the eastern states, particular for foreign investors. Again, a slap, an extra tax on property. That doesn't help with confidence. But look, overall, the confidence level was 128, neutral's 100. So might be the lowest level in 3 years, but we've come off a pretty high level.
Yeah,
so
haven't we?
I don't think we need to be investors are slashing their wrists just yet.
That's true. Well, thanks for tuning in tonight, but it's time for a break. And when we return, you'll have another chance to get a hold of a copy of Margaret's book, How to Achieve Property Success. But you'll have to ask a question and have it selected. So call now on 1300 30 34 35, or you can email us on property@skynews.com.au. Back shortly. Well, welcome back to the property edition of Your Money, Your Call. I'm Lisa Montgomery, and joining me this evening is Damian Collins from Momentum Wealth and Brad Beer from BMT Tax Depreciation. I'm sure you have a question for us, so grab that phone and dial 1300 30 3435 or email us on property@skynews.com.au. And we have another caller, and it's another Paul, and this Paul's from Sydney. Paul, how can we help you tonight?
Yeah, good evening, panel. I'm looking at venturing into a self-managed superannuation fund.
Yep.
The question's around land tax. So I guess from a New South Wales perspective, properties that are purchased within the fund, does the value of this property affect the tax-free threshold?
Right, okay. Now, when you say that you're venturing into an SMSF, that means that obviously you're looking to buy property within your self-managed super fund.
Yep.
That's right. So do you have other property, investment property, which is not in that fund?
Yes.
Okay, so, and you would probably have a number of properties, is that right? Or do you have a number, or is it just...
there is. Got a couple, yeah.
Right, okay. Just checking. Okay, I'm going to go to Damian. Damian's our expert on this. So, Damian.
Okay.
I'm putting my reformed accountant hat on. But, Paul, look, generally, an SMF is a separate entity, so I'm not 100% familiar with all the land tax issues in New South Wales, but a self-managed super fund is a separate entity, like a discretionary trust, like a company. It's all separate to you. So the taxation of that would be based as a separate entity. It would be similar, I would imagine, as if you set up a company. But look, I really think the best thing to do is, before you make any investment decision, is certainly seek advice from an accountant, or perhaps if it's a simple question, the actual State Revenue Authority in New South Wales might be able to have that clear answer for you on their website. But as a basic premise, the self-managed super fund is treated as a separate entity to you for legal and also taxation matters.
Anything to add to that, Brad?
Look, Paul, I think the reason for buying the property within the self-managed super fund is maybe something you want to question yourself, or question of the same accountant that you maybe get some of that advice from, someone that probably doesn't have that property for sale, making sure that it actually suits your overall financial situation. I suppose I think a lot of self-managed super funds actually get set up because seems like a simple way to get a property away. It's more difficult to finance. It's got less flexibility. Doesn't mean it's not right for you either, but just question the reasons around why it's actually done, because it is probably a bit more expensive to administer and a few things like that on the way through. But depends when you what your mid to long-term plans are, I suppose, with that property.
Yeah, it's one of those things, isn't it? With self-managed super funds, it's a lot of the time what I see is that people will establish them, take funds out of other superannuation organisations and put them in and let them sit at cash. So, because they don't really know what to do with it once they get into there. Obviously diversifying into property, which you can do now through your SMSF, but you are right, Brad, it is sometimes difficult to get the finance on those properties. And
I think more difficult now than it probably was in the past.
Yeah.
The ability to renovate's not there, develop's not there. The flexibility on when property's purchased through a self-managed super fund is just not quite the same.
No.
Just making sure you're aware of what that really is.
Yeah.
The big one about the super funds is the fact you can't gear against the growth. That's how most investors who've got large portfolios that get there. Most of us never save for maybe past our first or second deposit. From there, it's all the growth in those properties.
Yeah.
And the big thing for people to note is that when you've got a property and self-managed super fund, you can only borrow to acquire that asset. You cannot, if that asset goes from $500,000 to $1 million in value, that's fantastic, but that equity you can't access by borrowing. You'd have to sell it and start again, and of course there would be capital gains, albeit at lower rates within that super fund. So, so people need to be aware of that. It's really, we certainly don't give advice on this space because you need a financial planning licence, but for our clients who generally use them, they're generally been that sort of 50s, generally getting towards the tail end of their journey. They're looking to buy an investment property, salary sacrifice, pay it off, and then when they're in retirement, it will then give them an income stream. But look, there's a lot to think about, and really need to seek professional advice on
Absolutely.
that.
Lots of layers to the onion when it comes to SMSF, Paul. So good luck. So we have another caller now, and it's Mario from Melbourne, and you're calling about Frankston North, Mario. How can we help?
I'd just like to get the panel's opinion on it. It's a lower socio-economic area, but it's got a lot of potential. Near the beach, near the train. You're basically hoping it'll be a turnaround.
So really it's undergoing gentrification, or is it not as yet undergoing gentrification, North Frankston?
That I'm not sure. That's what I'd like to know, ask the panel.
Okay, well, why don't we go to the panel and ask them what they think. What do you think of Frankston North?
Mario, I do like Frankston, the whole surrounding region. It is, it's had in the Victorian context, a bit of a stigma about it. It's had a lot of social or state government housing in the area for a long time. There was particular areas that were considered, no-go zones, and they weren't quite that bad, of course. But so as you mentioned, there's a lower socio-economic generally level of people overall. But Melbourne is a rapidly growing city. Currently, it is the fastest growing population city in Australia of all the major capital cities. And long term, I was just down there over the weekend and late last week, and they're talking about Melbourne at 10 million people, and it's now 4.5 million or thereabouts. So what we continue to find is that those areas that provide some lifestyle amenity, which is near beaches and so forth, will be more and more in demand, and also transport, very big one. As we become more and more congested city, you'll find public transport's certainly an important factor. And now we do also have the Peninsula links that makes getting anywhere around that whole Frankston area. I was actually just down there over the weekend, went from Melbourne down in the morning to Peninsula through, and it's freeways all the way. So a lot easier to get around. So look, I think overall it will do, in terms of the Melbourne context, I don't think Melbourne will do a lot in the next couple of years, but I think if you're in for the long haul, if you want to be in Melbourne, I think Frankston North, you'll do perfectly fine.
Well, I think so too. And given that we have to go to a break, Brad, you might have to sit on what you might want to add to that, but we'll be back. So it's time for us to take a very short break, but when we return, you'll have another chance to ask your questions by simply calling us, like so many have tonight, on 1300 30 34 35, or emailing us on property@skynews.com.au. Welcome back to the Monday night property edition of Your Money, Your Call. I'm Lisa Montgomery, and joining me on the program is Damian Collins from Momentum Wealth and Brad Beard from BMT Tax Depreciation. We still have time left for you to call with your comment or question, and you may even be this week's book winner. So call now on 1300 30 34 35, or email us on property@skynews.com.au. And we're going to go to our first email of the night. Believe it or not, the show's been going an hour and we haven't answered one yet. And it's from Carlo. And Carlo asks, I've recently purchased an investment property whereby the previous owner has provided me a copy of the depreciation schedule. Am I able to use that, or do I need to get my own? Well, I mean, I'd be silly to come to you, Damian,
Wrong guy,
wouldn't I?
Lisa.
I mean, over here. Brad, BMT Tax Depreciation.
Look, Carlo, the depreciation schedule you've been provided has been done for a previous owner. So really you should get that reassessed for you. Now, some of the numbers, the written down value on the building allowance, should be applicable, because we would either estimate or come up with a construction cost at the time the property was actually built. The value on items won't necessarily be correct for you. You don't know what they've claimed, what they've done. I suppose it also depends on the quality of the depreciation schedule that's been produced the first time. Is it good? Is it bad? Reassessment for you is probably necessary, and for tax reasons, if you do get audited, the other one wouldn't stack for you because it hasn't been done for you. There's some scope to look at it to maximise for you as well, so make sure that's done, because that's kind of the important thing. It's your investment, not the previous owner's investment now.
Yeah, that's true. Did you want to add anything to that, Damian?
Only that, Carlo, we always recommend getting a depreciation report. In fact, our clients use BMT, and give Brad a free plug there. But look, we always look, and I remember very clearly when many years ago when I got one of my investment properties, it was an old-style house, and I thought, oh, could be a waste of money, but I'll still get one anyway. And guess what? The depreciation person found that there had been an extension done, and found me about $75,000 of additional deduction. So I'm of the opinion that you should always every investor should get one. I'm still surprised at how many don't. For the small cost, which is tax deductible, it certainly can be a big saving. And as Brad said there, you'll pick things up at a different cost base potentially from them. So yes, you certainly want to, for many reasons, go and get your own depreciation report.
If I could add one thing to that, on you should always get one. The quantity surveyor, if they've got some sort of idea, based on the address of the property, we can probably see now the photos of it and find a bit of information and ask you a few questions. We should really be able to, and we can, get an indication to make sure it's actually going to be beneficial before we go ahead and spend your money.
Yeah.
Like we say, twice the fee or it's free guarantee. We should ask enough questions and back our own professional ability to make sure it's actually worth it before we ask you to spend your money, and we can do that very easily.
That's great, because, I mean, modern technology allows you to see pretty much everything now, doesn't it?
Look, we've done a lot of depreciation schedules, so if the quantity surveyor doesn't have an idea or hasn't, you know, from some photos and some basic information about the property, can't get a rule of thumb of what they think it should be, maybe you should ring another one.
That's true. Before we move on to the next email, I just wanted to have a quick chat about interest rates because, you know, we are still in this downward curve of rates. And I was just looking the other day at what the cash rate was when we began this downward trend. And it was 4.5% in November 2011. And then rates have steadily gone down from there to the point where now we're at 1.75%. And that's a 2.75% drop. It's interesting what I'm actually seeing at the moment, and I don't know whether you guys are seeing it too, but we're seeing a lot of jockeying for position in the owner-occupier space, right down at that cheapest loan percentage. And we're also seeing fixed rates, some incredible rates for fixed rates, 3-year fixed rates under 4%, which are fantastic. And I'm just sort of thinking about investment property, fixed rates. I'll go to you first, Damian. What do you think about taking out a fixed rate loan when you are an investor?
Look, I've got fixed rate loans on a few of my properties, and I guess it's a bit of a gamble. You take the security you get from having you know exactly what you're going to be paying on that property over the next period of time. That's the benefit you get, but the trade-off is if interest rates go down further, you miss out on some of that. So I've tended to fix for 2-year time frames if I think it's a reasonable bet, and at least I know where my payments are likely to be. Look, I think, and the reason that the fixed rates, I look at the futures market and the interest rates futures market, and they're still pricing in over the next 18 months more rate cuts. And you see it with CPI at record low levels, wages growth negligible in many cases. So that the forecasts are that there's just nothing on the horizon that suggests, you know, with worldwide rates still coming down and negative rates through Europe, that there's nothing in the forecast that suggests that rates in Australia are likely to go up anytime soon. And we think they're cheap, but compared to the rest of the world, we're actually not that cheap. The rest of the world have even got lower rates. So, so again, one of the key things to be thinking about though with a fixed rate is once it's fixed, they are potentially hard to get out of. Some of the loans will let you make additional payments up to a small amount, and I've seen some pretty brutal break costs. I remember going back when a client came to see us and we hadn't set up the loan for them. They'd been somewhere else and got fixed at back in near the GFC time at 9.5% fixed for 5 years, and they came to see us. It was about a $400,000 or $500,000 debt, and the break cost I think we figured out was $65,000. So pretty brutal. So they're the sort of things you want to be thinking about. Are you committed to that property and that loan for that period of time, because the break cost can be very substantial.
And Brad, you know, while we're still seeing standard variable rates coming down, I mean, you're looking at these fixed rates, very tempting, isn't it? But are you a fan of fixed?
I've always been a non-fan of fixed, pretty much. The one thing a fixed rate does give you is a little bit of certainty of how much that is actually going to cost you. I've been burnt by the fixed rates, not really badly. I fixed in some loans back way when, and I was sitting at, you know, 7.5%, 7.6% around the start of the GFC on a few properties that, and I was getting new loans at 4.99. So for that period of time, I got burnt by those a little, and I've always been a bit shy since. It does give some certainty. My break costs, I remember at the time looking at those, and they were a bit ridiculous. Were ridiculous in context to the size of the amount of additional interest. So I actually let them ride because I didn't have that much time left to go. We are very low. The futures say low for some time. So I guess the important question is, have I gone and locked any of mine in lately, or am I starting to? And the answer is no. Because I think, although I do think at record low, we're not record low compared to the rest of the country. If you need some certainty, if you're concerned about what happens afterwards at some point, and afterwards being a time that you are prepared to lock in for, then it has a certainty associated with it. There's always the option of locking part of your interest in, I suppose, so you've got some certainty on that, knowing that you have no ability to possibly pay off or put into offset. See, it does mess with offset accounts as well, fixing rates sometimes. But look, have always have been burnt, and I think once they do the analysis, a lot of the time, overall, most of the time fixing doesn't necessarily win, because the bank fixes at a rate that they believe they're still going to make money out of, don't they?
Of course, yeah.
A bit of analysis.
So someone wins, it's either the borrower or the bank. So who do you think that is most of the time?
Most of the time, you're absolutely right. The bank gets it right.
That's right. But the other thing we have to consider too is if you do fix in, and what a lot of people don't realise is that rate will then go on to a variable rate. Now, that could be any variable rate, not necessarily the lowest rate that's being offered in the marketplace from that institution. And that's a really, I think what we should be looking at as borrowers is reviews very regularly. That our loan hasn't actually gone out of that competitive band, and you've seen that happen, haven't you?
Definitely, Lisa. Most of the banks will roll their fixed rates onto a standard variable, not the discounter. The standard variable rate that you quoted, no one really should be paying that, because you can get far cheaper.
Absolutely.
Generally 0.7, or even in some cases more than that as a discount. So rolling onto that, that's where I've read that banks make quite a substantial profit from that, because they're not going to call you up and say you can get a cheaper rate if you just ring up and call.
No.
They're happy to take your money. So generally, the first thing you do is, I would say, is look, if you're on you've rolled into a higher rate, call the bank up and say, look, here's the deal. If you don't give me a lower rate, I'm leaving. What are you going to do for me? And their retention teams might offer you a pretty sweet price. If not, go elsewhere.
Well, I know you do that all the time, Brad Beer, don't you?
Look, I've refinanced a bit. I think, though, that like you're looking at many other things about your investment and your property, and I haven't been as good sometimes at making sure that you've re-asked the bank, and I've got them spread across multiple lenders, the bank or the broker, to actually, are they re-asking that question appropriately? I went through a situation recently where the banks actually put up some interest rates.
Oh, yeah.
Which they did across the board.
Yeah.
And it was, funnily enough, my brother financed some things with the same thing. He said, they're stinging me. And I said, well, I'll go and ask the question. Because of that, I asked the question. They reduced all mine and they reduced his. But I had quite a few more, and they've been gouging's a little, probably not harsh. I'd been increased over and above unnecessarily. But when I asked the question, they actually moved it and reduced that. And if my brother didn't tell me to do that on that particular one, I probably may not have done something. But should the onus be at some point as a good broker to actually be making sure that you're doing the best for the client on the way through? And I don't know the answer.
Well, that's the brilliance of using a broker, because if you, and I never used to have this mindset, but the brilliance of using a broker is that they do have access to a number of products, and they should be able to place you not in just to a low rate environment, but also a product that's going to tick all the boxes in terms of, is it going to help you build your portfolio? Is it going to fit the needs and the circumstances that you have? It's not just a rate. It's a whole bunch of other things too, right?
Absolutely.
And also provide you with the guidance that you need. So that's what the broker should be doing. But the retention teams in the lending industry are growing, and it's very easy just to make a call, because, I mean, we have had, whereas we've had that 2.75% drop in the cash rate, that hasn't all been passed on to borrowers. And in fact, there's been some additional out-of-cycle increases by the big four banks. So you could be completely out of that competitive band.
And why, and it's interesting how that happens, isn't it? That you actually get you get changed, it doesn't get passed on, and there's cost of funds, and sometimes there's reasons behind that.
Well, that's right.
What sometimes probably I feel is a little unfair with the lender or the bank is the new loan always has the new introductory rate, the cheaper rate to come across, etc. About me, I'm an existing client. I'm paying my interest every month, and you no longer you just you charge me more money when I'm actually a good person, good client, paying my money all the time, paying my interest.
And that's rule number one before you make the call to get a discount off your rate, is to check out what they're offering new borrowers. If you check out what they're offering new borrowers on the homepage of their website, that's where it's going to tell you, then that's really the benchmark that you're hitting for. There should be a prize for loyalty, shouldn't there, Damian?
Yeah, oh, absolutely. It's interesting. I've had a few clients who we've said, well, look, we can actually negotiate with your current lender a lower rate. They're that unhappy that they've been gouged or maybe not informed that they could have got a lower rate, that they said, no, I want out of here. I just want to get out of there. So, so some people get a bit burnt by the banks and decide that they want to go somewhere else.
Well, that's right. And it's not implicit in the correspondence that they send to you. It used to be, but now some correspondence, when a rate is going down or going up, it will just have what the repayments are changing to. It's not going to tell you exactly what the percentage is that it's going to. So you have to actually physically go and look that up or make a phone call to find that out. And so if there's a 25 basis point reduction in cash rate, you may not be getting all of that, but by looking at your document, you might think that you are. And so that's really where you have to be second guessing and double checking, I think. Anyway. Welcome back to Your Money, Your Call. I'm Lisa Montgomery, filling in for Margaret Lomas, and it's been a great night tonight with wonderful callers and emailers. And I've had an expert panel, which includes Damian Collins from Momentum Wealth and Brad Beer from BMT Tax Depreciation. Now, our lines are closed for tonight, but we have time for a couple of last questions, so let's get to them. So we have a great question, actually, from Matthew, and he asks, I'm looking to invest in a property worth a maximum of $500,000 within South Australia. What areas do you feel would be the best for long-term capital growth? Now, that's a really broad question. I know that we talk a lot about South Australia on this show, certain areas of South Australia. Adelaide's had moderate growth, not tipped for any substantial growth anytime soon. But what do you think, Damian? If you had $500,000, what would you do?
Matthew, for $500,000, I wouldn't actually put it in Adelaide, but you've mentioned that you do want to go into South Australia, and I guess, look, one of the things that we look at in assessing the capital cities and even regional towns is really got to go back to fundamental demand and supply analysis. So in terms of a capital city, what you're looking for is a capital city that's got strong population growth, and South Australia or Adelaide doesn't have particularly strong population growth. It's well below the growth rate of Sydney, Melbourne, Brisbane and Perth, which are the other four major capital cities, so that's not a good sign. The other thing I look at is what are the industries that are likely to sustain that city, and obviously manufacturing at the moment is still in decline. We've got the car industry shutting down over the next couple of years, and obviously problems with Arium and a few other bits and pieces. So nothing's standing out to me as any particular industry or comparative advantage that South Australia has in terms of property investing. And then obviously even those industries that are there, are they high paying? Because it's great that tourism is going well and growing on the Gold Coast, for example, but all those wages pay about $50,000 a year, not enough to generate people being able to afford to buy higher priced properties. So sorry if I'm sounding negative on South Australia and Adelaide in particular. If you're going to go to South Australia, I'd be going to Adelaide. And look, the good thing is that the prices are particularly relatively very inexpensive compared to certainly Sydney and Melbourne. People would be shocked at what you can get. And I try to stick around, given it's a low growth, low population growth, I try to stick around Glenelg, areas with some amenity. You've got obviously the light rail system down that way, and now 500,000 you won't get necessarily a house, but you might get a villa or a townhouse or apartment, perhaps not right on the beach. I'll be looking down there. The other one is down the south, maybe Bedford Park might be one. The median's about 440 down there. I think that's got some, you know, some potential there as well. But look, overall, it's one of those things when you're in a market that all prices are growing, it lifts. Makes, if you make mistakes, it sort of covers them up a little bit. But when you're in a market that's pretty tough to get growth overall, if you make a mistake there, you're going to find you're in pretty much a very flat period of time. So you need to do a lot of homework before you get into that market.
Yeah, interesting, isn't it? You know, Brad, Margaret continually talks about the Onkaparinga Shire down toward Christie's Beach, down those areas where the train line now is going in. It's interesting though because we still haven't seen any momentum happening there. What's, you know, for your money, what should Matthew do?
Look, I probably am similar to Damian, and my money, you know, at $500,000, I don't think Adelaide or is the first place I go. And Onkaparinga, I know Margaret has been strong on it for some time. I think the ability to subdivide or develop in that area has been something that's been attractive to her, which I think is definitely something that has the ability to be attractive as part of your overall portfolio, and a quick way to probably make some equity. And we're in at a lower price point to get into these things and make them happen. But trying to develop in areas where the end value is a little bit tough also brings its challenges, I think, sometimes. I think the amount of industry, etc., as Damian pointed out, happening in Adelaide isn't exciting me right now. There's more probably negative towards that than positive. And I think there's other capital cities I probably would look at first.
It's interesting, isn't it? I don't think haven't said anything positive, have we? Really?
Sorry, Matthew.
To help you out, Matthew, we do apologise, but you know, we think that there will be growth, absolutely, in South Australia and Adelaide, but it's not coming anytime soon. That moderate growth is sticking there. Interestingly, Hobart is one of those capital cities that's tipped to be, you know, moving as well as Launceston over time. So that'll be interesting to see what happens down there. Just saying. Now, here's another good question from Penny. She is from Melbourne and she's asking about depreciation, and she writes, I purchased a 2-bedroom, very old house on a half a block last year. The cost was $400,000. Renovations are new kitchen, polished floor, painting, replacing some windows. Total cost $30,000. The rent is $19,000 per year. I'm 64 and earn $30,000 per year. Is it tax effective to use a depreciation method schedule? If using depreciation, can I use 10% on the electrical appliance and polished floor? Okay, Brad.
Well, look...
complex, mate.
Yeah, it's complex, but not too complex. Penny, the property itself will have some depreciation available. I'll probably address the second part of your question first, which is, can I use 10% on appliances and polished floors? Different items within a property have different depreciation rates. 10% is not necessarily the right rate for those items. We come up with a part of the construction cost and apply a 2.5% rate to that, and different items in the property have an effective life that comes back to a percentage. And you can find that effective life on an app called Rate Finder that we've actually built to come up with some of those rates. But generally, it's probably good to get the expert to look at those deductions. Your situation with your income where it is. One thing we haven't got there is the gearing on that property and what your tax situation looks like. Depreciation is going to create some tax deductions, but if you don't need them, they're no good to you. With a $30,000 income, then if you're already in a negative situation on the rest of the property where you're paying out some expenses and you've got some deductions, you may not be paying much tax on that income. Depreciation adding to that as another deduction is not going to help you. However, if you don't have much gearing and your expenses are low in relation to that property, and therefore all that rent would add to your income and be deductible, depreciation is going to help you. The rest of those numbers you should be able to work out fairly easily. Your accountant will help you with that. Depreciation definitely will apply, and there definitely will be some there if you actually need the deductions.
Yeah, it's really complex, isn't it, for a lot of people, the depreciation piece. But hopefully that's helped Penny with her decisions. But it's complex, isn't it?
Yes. Look, what you can claim for what can be quite complex, but you just need to know whether the deduction is going to help.
Is going to help, that's right. Well, that brings us to the end of tonight's show. Many thanks to my two wonderful expert guests this evening, Damian Collins and Brad Beer. They will be back on the show again very soon. Thanks also to all our callers and emailers. And tonight, our question of the week goes to Joe, who called about Fortitude Valley, and Carlo, who emailed about the depreciation schedule. So if you would both like to email me on lisa@lisamontgomery.com.au, I'll send you your books. You can follow me on Twitter @LisaKnowsMoney, all one word, and make sure you tune in next week for another great show. Of course, Margaret will be back in this chair along with another two expert guests. In the meantime, have a great week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.